The summary of my opinion is that probably be sideways for the remainder of 2023. I have the monthly chart on the left and the yearly chart on the right. I want to summarize what I have been talking about. Obviously, all trends eventually evolve into a trading range. On the monthly chart, we've had several small legs down, but the follow-through on the way down has been bad. This is a trend. We have a series of lower highs and lower lows, but it's not nearly as strong as the bull trend was here on the way up. This is probably a bear leg in what will become a trading range. And when I say a trading range, I mean at least a couple legs down and having at least 10 bars in it. This is probably a first leg down, and at some point we break above the bull channel, which we might be doing now, and then we get a second leg down. We could have many legs sideways to down, and the legs could go all the way down here, and it could become a very large trading range. But more likely it's going to be a trading range that's something like this. And at some point, the trading range will break to the upside. On the yearly chart, we had a trading range, a couple legs down, about 10 bars or more. And then eventually you get a breakout. And in a bull trend, no matter how long a trading range lasts, the odds still favor an upside breakout. The more bars that are in the trading range, the more the probability of the upside breakout gets closer and closer to 50-50. But if the trading range is only 10 bars, 20 bars, the odds still favor an upside breakout. This sell-off is deep enough to make bulls wonder if it's a trading range instead of a bull flag. A bull flag is a reversal. Sometimes it's just one bar like this, sometimes it's many bars, and then the bull trend soon resumes. A trading range, you have a leg down, you have a leg up, and then you have another leg down at a minimum. And this is deep enough, and it's lasted long enough so that many bulls are wondering if this is the start of a trading range, and that whatever rally we get will fail, and then we get a second leg or more sideways to down. Now think about this. On the way up, bulls are buying, 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 buying. And why do they do that? Because they think they're going to make money. They think that one of two things will happen. Either if they buy here, it just keeps going up and they can make money, or it'll go down and it'll be a brief move down and it will get it back to the price where they bought, and they can either get out, break even, or hold, and it'll go up and they'll make money. This is deep enough to make these bulls wonder if, instead of the bull trend resuming immediately, we're going to go sideways for a long time. If we're going to be sideways for another 20 bars or so, many of these bulls will look elsewhere for investments for their money. And these bulls, therefore, will look to exit this position if the market gets back up here. We don't know how many disappointed bulls there are, but there certainly are a lot. When you have a deep pullback that lasts a lot of bars, a lot of the bulls will exit around where they originally bought. So the bulls who bought up in here, a lot of them are looking to exit, sell out of their position here. And if enough do, you'll get a second leg sideways to down. So I think this sell-off is big enough and it has lasted long enough so that there will be a substantial number of bulls looking to exit around here, and then they'll wait to see how far down it goes and look to buy again, or they'll look elsewhere for their investments. I want to say one other thing about these disappointed bulls who bought up here. If the sell-off is very deep, I don't know if this is deep enough, but if the sell-off is very deep, a lot of the bulls will be so disappointed that they think it'll take a long time before the market gets back up here. And they don't want to wait several years. Instead, what a lot of them will do is buy more once they see a good-looking reversal up. This is a good-looking reversal up. And then they'll look to exit at the midpoint of their two buys. So if a bull bought here and a bull bought here, or if a bull bought below that low, anyway, you got a bull buying here and then other bulls buying more here, their average price is here, which is around a 50% retracement. If a lot of the bulls exit around 50%, you get a lower high around 50% and then another leg down. And that's part of the reason why 50% retracements are so common. You have scale in bulls, bulls who bought more, looking to exit at their average entry price, which is right around 50%. And the bulls sell, the bears sell all the time. With the bulls selling out of longs and the bears selling into shorts, the market stops going up and it starts to go down for a second leg. One of the hallmarks of a trading range is disappointment. The bulls obviously are disappointed that the market has stopped doing this and it's now doing this. And the bears will be disappointed if this leg continues up strongly and goes up very far. One of the ways that trading ranges disappoint traders is they tend to break out to the upside and then reverse down. They tend to break out of the downside and reverse up. We have an attempt at a wedge bottom, 1, 2, 3. And if we go up and then down here, we'll break below the wedge. In general, whenever the market breaks below a reasonably good bottom, there's a 50-50 chance it'll go down for some kind of a measured move. And there's a 50-50 chance the bear breakout will fail and the bull trend will resume. Likewise, if you break out of the top, there's a 50-50 chance the bull trend will resume and you'll get some kind of a measured move up, maybe based upon the height of this range. And 50-50 chance there'll be sellers up here and you'll get another leg down. And that's what typically happens in trading ranges. You often get breakouts above prior highs, like above this, above that, and they fail, and then you reverse down. And you get breakouts below lows, and they fail, and you reverse up. Here we have a low, we broke below it, and we reversed up. On the yearly chart, this was a reasonably big bear bar last year, 2022, with a reasonably big body, and it was an outside down bar. However, at the moment, it's simply a pullback in a bull trend, like that, or like this, or like this, or like that. It closed below its midpoint, and it's outside down. Good for the bears. It's also a third leg up. 1, and then a bear bar, 2, and then a bear bar, and then 3, and then a bear bar. Whenever you have 3 legs up, you're going to attract some profit taking, and a lot of the bulls will give the bears a couple attempts to reverse it into a bear trend. So whenever you have 3 legs up, I call it a wedge, and when it's in a tight channel, I call it a parabolic wedge. You're still probably going to get a couple legs sideways to down. So this could be 1, and then bounce, and then 2 next year. So I think next year will probably be sideways to down. We could go up for 2 or 3 years and then get a second leg sideways to down. But I think 2022 is a parabolic wedge reversal in a channel that has lasted a long time. So it's probably going to be the first of a couple legs sideways to down. It's a pullback in a bull trend. The bulls hope it's a bull flag, but it's a decent bear bar. We have a parabolic wedge. There probably are more sellers than buyers above its high. So if we go above this high, there probably will be more sellers than buyers somewhere up here, and that will cause the second leg sideways to down. However, the bull channel is very tight. The pullbacks have been brief. A brief small pullback here and again here. It's unlikely a bull trend would go from this into a bear trend. And therefore, there probably are buyers not far below last year's low. Also, last year was an outside bar, and right now we're in the middle third of last year's range. What often happens when you have an outside bar is the following year or the following bar is an inside bar. So I would not be surprised if 2023 was a bull inside bar. It would be a better buy signal bar if it was a bull bar closing near its high for a resumption of the bull trend next year. But as I said, this is pretty good selling. It's a third leg up. Even if this year turns out to be a bull inside bar, I suspect we'll only go up for a year or so, a bar or so, and then have another attempt to go down, maybe a year or 2 down and more sideways. There have been many reversal attempts on the yearly chart, and most of them were brief. There's a 40% chance this is the start of this, a trading range, or this, a trading range. Here we had a new high, and new low. Here we had slightly higher high, slightly lower low. But right now there's a 40% chance this is the beginning of something that looks like this or like that. This is about 10 bars, that's 10 years, it's a decade. This is about 10 bars, 10 years, a decade. We're going to do this or some other kind of trading range at some point within the next few years. Right now, there's a 40% chance this will be the initial high and that we've begun the conversion into a trading range. 60% chance, even if we go sideways to down for another bar or two, 60% chance we're going to try to go up for several more bars above this. Maybe we'll have to go above 5,000, and then this becomes a final bull flag and we reverse back down to this low. Remember, this is the pandemic low. It's 56% down from the high. There's currently only a 20% chance that we'll ever get there. And if we make a new high here, and if it goes up 5,500 or so, this then becomes 65% below the high. So the higher up we go, the less likely we will ever get down to this price. You're never going to see this price again in your lifetime. It's not going to drop down to 1,000. You're never going to see this price again in your lifetime. You'll get people on television or on the internet making outrageous claims that will get down to these lows, but it's never going to happen. Remember, when you have 3 pushes up in a tight channel, it's a wedge on a lower time frame chart, and on this time frame, it's a parabolic wedge. We have up and then a bear bar, up and then a bear bar, and up. On the daily chart, this would be a wedge. It was a wedge on the daily chart. On the monthly chart, is a parabolic wedge. You'd expect at least a couple legs sideways to down, 1 pullback, 2. Well, we've actually had 3. 1 bounce, 2 bounce, 3 on the monthly chart. When you have a wedge and you get a reversal, typically you're going to get a couple legs sideways to up. You might get many legs up, but at a minimum, we should have a second leg sideways to up. Now, I'm recording this chart on February 5th, and I know the market has already gone above last month's high, but I still think it's a rally in what will become a trading range. I think there's still probably a 60% chance we're going to stay below this high and then get a second leg down. How far down will that leg go? Well, I still think there's better than a 50-50 chance we're going here. This is on the March contract. When March expires, we'll be in the June contract, and this price will be different. But 4,000 has been an incredibly important price. I talked about it as it happened. I talked about it after it happened. When you have 2 important prices, the all-time high and then 4,000, they often create a measured move to a third important price. So I would say better than a 50-50 chance that this is the target, that no matter how high up here we go, we'll have to come down here. If we go all the way back up here, that reduces the chances we'll get here. It increases the chances that if we do get a second leg down, which still would be likely, it will hold above this and maybe form a triangle. So 1, 2, 3, bounce, 4, and then 5, breakout mode. Since it's in a bull trend, the odds would still slightly favor a bull breakout. What's the worst case scenario? How far down can the bears push this? Whenever you have a triangle, in this case we have an expanding triangle, it's an area of agreement, and the market tends to come back to that area of agreement. If we went to the downside, we probably would eventually rally back here. We broke to the upside, and therefore we may come back to the middle of the expanding triangle, which is here. Right now, I think we probably will not get there, but I do think we'll get here. On the yearly chart, there's no sign of a top. It should evolve into a trading range lasting at least 10 bars, 5 or 10 years, and it should begin within the next few years. There's a 40% chance that last year was the start of the process. This is a bad buy signal bar. There are probably sellers above 2022, but it's a very strong bull trend. There are probably buyers below 2022. With buyers below and sellers above, we're probably going to be sideways for at least another year or two. I know you're watching this video hoping for clarity, And I am giving you clarity, but it's not the clarity that you want. The clarity is we're probably going to be sideways for at least another year or two. What you want to hear is this is the end of the sell-off and we're going straight up to a new high, 6,000, 7,000. Or this is the end of the world and we're going to go below the pandemic low. But that's not what's likely. What's likely is we're going to be sideways for the remainder of the year and probably sideways well into next year. On television, they always put people on who say things that attract eyeballs and generate a lot of emotion because that helps them sell ads. So you'll always get people making claims that the market is going to go up to 10,000 or down to 1,000. It's never going to go down to 1,000. It eventually will go to 10,000. It eventually will go to 100,000. We won't live long enough to see it, but eventually it will get up there. Because I'm talking about a trading range, it's going to be different from most of the bars on the chart. Most of the bars on the yearly chart, we've been going up. And on the monthly chart, I'm only showing a small part of it. We've also have been going up mostly. We've had some sideways times for a year or two or three. But I think this is going to be another one of those sideways times and not like this. And on the yearly chart, as I said, 40% chance we've begun this. 60% chance we'll only be sideways for 2 or 3 years and then we'll get another push up. But at some point in the next few years, we're going to begin this. So I do not think there's much left to the upside. Maybe we'll go 5,500, 6,000, and then enter a trading range for a decade or so. 40% chance it has begun. Again, yearly chart, probably mostly sideways this year and probably next year as well. However, I also think the market will develop into a trading range with a couple obvious legs down and up within the next few years, and it probably will last a decade. Monthly chart bear trends are rare, so even though we've sold off a lot, I think we're going to be sideways for the remainder of the year. And I think there's better than a 50-50 chance that we're going to get down to that measured move based upon the all-time high and 4,000. Again, I'm Al Brooks. I hope that you found this helpful, and I hope that you have a good year.